It's a great pleasure for us to be with you. I'm Bobby Coates, a professor in the Department of Agricultural Economics and Agribusiness in the University of Arkansas System Division of Agriculture. Now joining us is Bryce Knorr, Farm Futures Senior Grain Market Analyst, to discuss what's ahead for the grain markets. Bryce joined Farm Futures magazine in 1987. He conducts exclusive surveys on acreage, production, and management issues. Besides the morning call on farmfutures.com, he writes market outlooks for corn, soybeans, and wheat that include selling price targets, charts, and seasonal trends. Bryce's other market outlooks include basis, energy, fertilizer, and financial markets. I give you Farm Futures Senior Grain Market Analyst Bryce Knorr on what's ahead for the grain markets, big crops, and tariff troubles. Bryce, we certainly look forward to your grain market outlook presentation.
Well, thanks, Bobby.
Yes, sir.
When I did this presentation a couple of days ago for some growers in Illinois, it was just big crops and tariff troubles. Now maybe we need to put a question mark by that tariff troubles after news today that maybe China and the U.S. are going to be at least talking about having talks. Some Chinese officials will be in Washington next week for those discussions. So that's why the soybean market rallied sharply today, just on the hint of perhaps some good news. But overall, we're still, I think, in a situation where the market has plenty of questions that could linger over the market for quite some time. Of course, Friday's USDA reports did nothing to really alleviate some of those concerns. We saw some big, very large carryout in crops. Corn crop, USDA put their yield at 14.586, the size of the crop at 14.586 billion bushels, yields of 178.4. Those are both more than the trade had anticipated. The soybean numbers also bearish. Anyway, the bean crop, record large 4.586 billion bushels, near record yields 51.6 bushels per acre. So the old crop carryout for corn and soybeans were actually pretty positive. USDA kept the carryout for corn unchanged, and beans actually went down 35 million bushels due to stronger crush and export. But the new crop soybean number, with those carryout at 785 million bushels, was really the bearish straw that broke the bull's back if they had any left. Although we have tried to recover now here the past day or so. The wheat numbers actually friendly. Again, USDA lowering carryout by 50 million bushels, and the corn number is certainly not burdensome and down significantly from where we will end on September 1st. But taking a look at just which of the methods we use to try to estimate yields are the most accurate, typically for this August report, the survey that Farm Futures does has the best track record. But this year, USDA's crop ratings, even though they came in for a lot of criticism, turned out to be the closest with the nationwide rating that we project, according to our model, half of a bushel away from where USDA came out. Now, when you take a look at what's the most accurate, looking at all of these estimates, when we finally get to the final crop size in January, the August USDA report actually does the best job out of any of the methods that we use. It doesn't catch all of the variance, but certainly quite a bit of it. So USDA put the yield in Arkansas for soybeans at 50 bushels per acre, down one from 2017. Now, our ratings model was just under 55, a little higher, but that has been trending lower. Overall, the soybean yields based on the crop ratings have lost about a bushel per acre since the survey was taken. So perhaps some indication that the crop is getting a little smaller. Now, the corn, much easier to predict in August than soybeans. Crop is obviously further along. I think that's what probably accounts for that. All of the methods that we use do a pretty good job of predicting what USDA will come up with in August. The U.S. crop rating, again, was the closest. Again, a lot of people scoffed at that 180 bushel per acre number, but USDA was quite close to that. Now, when you look at what's the most accurate way in August of finding out what might happen when USDA puts out its final numbers in January, the weather model actually does the best. This is based on weather, the July rainfall and temperatures, along with June crop stress and how fast the crop is planted. And that has historically done the best. Now for corn, USDA put the Arkansas yield at 182. Since they don't do crop ratings, we don't make an estimate for Arkansas on a weekly basis. Overall, the ratings have been easing. They've lost a bushel or two since USDA did its survey, but they're still very much in the ballpark of what USDA came up with, kind of closing in on that territory. We also look at vegetation health index maps. They've been deteriorating for the past few weeks, just like the crop ratings have. For soybeans, they're just over 50 bushels per acre, corn 176. So right between where our survey landed and where USDA came out. Now, if this were a work of modern art, we might call it, do big crops get bigger? This is what the corn painting might look like. This is soybeans. And what this is, the horizontal axis is whether the crop is larger or smaller than average. If it's larger than average, those dots veer off to the right. If it's smaller, they veer to the left. The vertical axis up and down is how much the yield changed from August until January. And looking at this, it does look like an abstract art because there's really no pattern. And that's the point here. If big crops got bigger and small crops got smaller, you would expect to see those dots in a nice orderly line like that. But that hasn't happened. And that's an indication that there's literally zero correlation between these August yields and whether or not they're above or below average, and whether or not the USDA's final yields are greater or lower. So right now, we really can't say just because we have big crops, that means they're going to get bigger. But for corn, it looks like if these yields hold anywhere close to these levels, we're going to have 6 years in a row of above average yields. That's only been done once before, from 1996 to 2001. Prices were terrible then, and they aren't very good now. The good news, however, is that production is expected to fall below demand. So that means tightening stocks. And that's a trend that is positive for prices. We're seeing a slow growth in feed usage, also fairly slow growth in industrial usage. Most of that, of course, is ethanol, also sweeteners. And exports could tail off a little bit in the coming year from the very strong level we saw this year. But the trouble with exports is they're not growing. Right now, they're about as good as they've gotten over the last 40 to 50 years. And they really have been overall capped. So we can't count on exports bailing us out, which means that the ending stocks may not get a whole lot smaller unless USDA does lower that projection of production in coming reports. Now, the stocks to use ratio, that's how we measure relative supply and demand. It's down for the 2017 crop year, and it looks like it's going to be down for the 2018 marketing year as well. So again, that's headed in the right direction. Where things really get interesting is when you look at the world situation for coarse grains, and again, production below consumption for the second straight year. And when you take out China, where they have very large supplies, so we take them out to avoid some distortion, basically we have some very tight world carryout projected for the 2018 marketing year. Of course, a lot can change. The growers down in South America haven't started to plant their crops that they'll harvest a year from now. And also Australia, we don't know what's going to be happening there with their coarse grain production, but certainly they're in the grips of a drought, so it could be lower. So a lot of variables in play, but the world of stocks to use until recently has had a close correlation with prices. And if that correlation were to hold, it didn't hold for 2017, but we'd be talking 550 corn rather than 350 corn. And indeed, my price forecast, if ending stocks for 2018 don't get much bigger than currently projected, about 375 a bushel. That's assuming a better demand and a smaller crop. If the crop is as big as USDA says it is, then we're probably looking more at 350. Again, just depending on how production and the demand holds up. When you look at that top third of the futures price range, we've already entered that in on our spring rally. So we've been there and done that, and it may be rather difficult to get back into that selling range, which is basically a profitable level for the average grower. Again, unless we can put on our blinders and move beyond all the trade disruptions. December futures had a nice rally today. Is trying to get above a long-term trend line off the May and July highs, was able to move above the 50-day moving average today, so that's positive. So also a basis is starting to recover. This is a Memphis corn basis, trading above average as we head towards the end of the market year, recovering from the very weak levels that we saw a year ago. So that's a positive sign. And you'll note what the basis trend is. We tend to get a pop higher into after harvest into the delivery of December futures, and then kind of just trade flat. So perhaps an indication again, the best time to move this corn if you have storage is not to hold on to it long term. I look at the July futures seasonal trend. That's where we are now. Again, most years we get a little bit of a pop into Labor Day, maybe after harvest, and then after that it's a slow grind lower. Sometimes we get a bounce in the spring like we did this past year, but we can't count on it most years. So we really have to be careful about long-term storage. One factor to look at for storage is carry. December, July carry trading around 24 cents. That's not much. That's one reason for the weak basis we saw last year is the carries just haven't been very big. The Board of Trade is trying to change that. They'll be adjusting the storage premium used on grain and deliverable positions. After the harvest next year, it's going to go from 5 cents a bushel to 8 cents a bushel. That should widen out the carry for the 2019 crops, but won't be helping us this year. When you look at the potential for basis strengthening after harvest, this is the barge freight from Memphis to the Gulf from late September to December, January. We're talking about 18 cents freight potential for basis strengthening plus 12 cents carry, so about 30 cents if you're looking to store grain for a basis hedge. I look at various storage strategies. This goes back to 1990 for Memphis, looking at futures and options, also commercial storage and cash. On average, the on-farm storage into late spring, early summer is the most profitable. The storage hedge does a little better. That's would be selling July futures at harvest. It doesn't beat just the on-farm storage all that more often. A little bit more of a conservative play. But again, I think growers have to take a real long, hard look at perhaps selling those post-harvest rallies and maybe doing some hedging then to capture the storage gains on the basis, buying some call options if you're still bullish. Also, take a look at December 2019. If we can get a bit of a rally, there's a lot of resistance up there around $4, $4.10. Don't know if we're able to get much through there, but there are going to be some opportunities. In fact, you can sell $4 corn for next fall now. For soybeans, we've got the same problem we have with corn. We have 6 years in a row of above average yields. That's never happened before in soybeans, truly unprecedented. You can see just how good the yields have been as we've shifted production out of corn into some of the higher yielding areas. Production, it's the light area, just outstripping demand the last 3 years here. That's one reason why that carryout is building so rapidly. The crush actually pretty good. However, total demand projected to slip due to exports. And again, that's caused in part by the uncertain demand from China and USDA assuming that those tariffs are going to remain in place. That's pretty much what you have to do, although I figure things both ways. But what it looks like with that 785 million bushels, the highest corn carryout really in 20 years or more, or soybean carryout. So the stocks to use ratio, bearish force right now. World production also forecast to increase in the year ahead. And the U.S. share of the world export trade just continues to grind lower. That's a long-term trend. We were able to hold on during the boom years from China, but with slowing Chinese demand, that's hurting our market share. So the world stocks to use ratio for soybeans in the coming year, everybody has average or better crops, basically would be an all-time record high, certainly bearish for prices. Now, one thing about the tariffs is you can't blame the tariffs entirely for low soybean prices. We just have too many soybeans, and Chinese demand has been slowing. It's closely related to GDP. Their GDP growth has been slowing, so their rate of soybean import growth has also been slowing. There's a pretty good correlation there. China's economy is slowing, and the trade dispute isn't helping that at all. But it was slowing down even before this tiff with the U.S. Also, some questions over the last few years about lower soybean protein content out of the U.S. That may have also been a factor why our export trade with China was slow even before the tariffs went into effect. But right now, China accounting for only 48% of our soybeans. Normally, that's 57 to 62%. So when you take a look at this, these fairly bearish factors, even if the crop is a little smaller, we're still talking $8 cash beans. Even without a tariff, if the crop stays about the same size, you're not really talking about much of an increase in average cash prices. The futures, November futures, already been into that selling range. Getting soybean futures back to a profitable level, really going to take some encouraging news. Today, we certainly got some, of course, with the announcement that two sides are going to be talking. But it's a long way back to $10, and not to mention profitable levels for the average grower. The July soybean futures seasonal trend, that's where we are now. Again, as with corn, kind of a little bounce into Labor Day, another one into after the end of harvest. And then it could be a long, cold winter unless there's some red-hot demand from China, which doesn't look likely, or problems with the crop growing down in South America, which, of course, can always happen. Australia or Argentina had a bad crop this year. So, you know, they can always have problems, but you certainly can't count on it. And on the average spring rally, it doesn't even get back to these late fall highs. So that's one reason, particularly in soybeans too, some post-harvest sales, if we get that bounce, can be a good idea. Now, this is how long the storage strategies out of Memphis fared since 1990. Cash soybeans normally the best for producers most places, but due to your early harvest and the possibility for that most of the basis gains come early, you may be better off actually storing on paper. Again, you get a basis bounce, sell the beans, buy the board, or do a basis contract. That has the same odds of success as a cash soybeans long-term storage into late June, and on average actually makes a little bit more. Plus, you'll also have some cash flow. The soybean export inspections, again, started slow, have actually stayed above average this summer, so doing fairly well towards the end of the growing season. Brazil has record exports, but a lot of what they're selling is going over to China. Now, the question is, can Brazil satisfy China's protein animal feed needs? On October 1st, Brazil is forecast to have 878 million bushels on hand. Demand during the Octis quarter last year was just a little bit more than that, so in theory they probably could. But Brazil doesn't normally sell too much more than 70% of its soybeans to China. That'll be up this year. But other people are buying from Brazil too, or bought previously. And that's an indication that the U.S. is going to be selling some soybeans to China. This is the October price out of Brazil. That's the October price out of the Gulf. The difference is about 20%. That tariff is only 25%. In fact, we saw one ship finish unloading today, another one start, 3 more ships either docked or en route to almost 12 million bushels. So China canceled one purchase today, but there's still some activity where it makes sense for the buyers to take delivery on those soybeans. Now, the other thing that's happening in China, their stock market is very weak, and their currency, the yuan, is weak. When the price is high here, that means more yuan to the dollar, so it's weakening versus the dollar. Talk about whether or not China is trying to start a currency war too to maintain their exports, stimulate their economy. The trouble is that's also causing Chinese investors to move money out of the country, which could be very bad for their economy. And it's not just China. We've got tariffs on Turkey. We doubled down on those because they will not release the pastor that's been detained over there, caused a financial crisis. Now the Turkish lira traded to an all-time low this week, pulled back a little bit the last day or two on some things the central bank was doing. Also looks like they might get some emergency funding from Oman. But this is spread to other emerging markets. The Argentine peso, their economy's been a mess. And the peso weakened to an all-time record low this week. The central bank raised interest rates to 45%, trying to stem that slide. So Paul Volcker, eat your heart out. Even he couldn't do that back in the 80s, and it hasn't really helped. Also, the Brazilian real weakening. When this chart goes down, it actually means the currency is weakening. That's an incentive for growers there to expand. Their prices are set, in many cases off the board of trade price in dollars, and that's converted to real. They get more of them, so they have an incentive to expand. The dollar benefiting from safe haven buying. It's still the currency of choice when there's panic around the world. And even though that eased today, the dollar actually strengthened. And the dollar has also been following interest rates. Interest rates are moving higher, and when that can attract investors to a currency looking for a safe, guaranteed return. The short-term interest rates, that's that bottom line. They've been ratcheting slowly higher for the last 2 years. Probably have a couple more quarter-point increases ahead this year as well. Longer-term rates, they're trying to stabilize around 3% on the 10-year note. That's actually been helped by this all the economic angst. Reason why the Fed is tightening, first of all, they want normal interest rates. Also, inflation on the rise, 2.7%. That was the most since 2012. So we're starting to see inflation, which is something the Fed wants. It means the economy is getting back to normal. Now, this is also affecting the grain market. Russia, of course, we have sanctions on them that caused more weakness in the ruble this week. To move to lowest level since they invaded Crimea. And What that's done, the wheat prices were already strong due to poor production out of the Black Sea area. Combined with that weak ruble, it's driven wheat prices in Russia to all-time record highs, at least when they're valued in ruble. European wheat prices also quite strong. They had a disappointing crop there. And then the euro has been weakening as well. And when a currency weakens, that tends to inflate the price of commodities that are denominated in that currency. That's one reason why U.S. Grain prices have been struggling lately due to that strong dollar. Now, wheat could be the thing that bails out corn and soybeans. World production falling below demand this year. And with that to El Nino, looks like it's already in play now. It may end by spring, but it will be in force to, looks like, reduce wheat production sharply in Australia. Overall, world wheat ending stocks, again, without China, going to be about the lowest in a decade. When you look at the stocks-to-use ratio of the major exporters, that's the U.S., Argentina, Australia, Canada, the EU, and the former Soviet Union, they're basically as low as they've ever been. This is dating back to 1960. So the U.S. Crop also looking like it's going to be below demand. Unfortunately, exports, the sales picked up today, but the inspections, the shipments have been weaker than normal, weaker than last year. So even though there's potential for exports, we haven't seen them yet. And on a year-to-date basis, this is what we've done so far. And even with the sales today, the total commitments really at the low end of their range for the last 30 years. USDA, again, forecasting an increase. We'll see if it happens. Even if it does, we're talking about better exports, not great exports. The ending stocks moving in the right direction, falling, but again, still fairly high, not anywhere near the level needed to produce major rallies. I'm not quite as optimistic on USDA in terms of prices and stocks. We've already hit my selling targets, so any rebound now, probably a selling opportunity. Chicago wheat was able to hold the 50% retracement of its spring to summer rally. So that's a positive sign. But now, basically, we're trying to get a rebound rally that would be a selling opportunity. The good thing about the wheat market, these are the long-term cycles in wheat dating back 1974, both up and down, just how long it takes to complete a cycle. And the wheat market tends to be one that trends. The average cycle up is 28 months, but it could be a lot higher, a lot lower than that. If we do get a 28-month cycle high, that would come sometime around March, presumably on weather, spring weather, winter kill, that sort of thing. So what can you do if you have storage and have wheat? Well, you can sell the carry. There's a good carry still from September to May. And so storage hedges can be profitable in wheat. And taking a look at the seasonal trend, watching that closely in bullish years, we tend to do what we've done this year, which is the August high takes out that spring high. In bearish years, we don't do that. We just tend to keep grinding lower. The trouble is last year, we also started off in the right direction like we're doing this year. And then the market just broke hard and kept on going. So last year's rally didn't hold, and there's no guarantee that this year's bounce may hold either. If it does, it'll be the funds doing the buying. The funds turned long in soft red to winter wheat for the first time in over 4 years. They don't have on a real large long position, but they are buying. That's positive. That helped overall. The fund's getting a little bit more interested in agriculture. This is a net long position in crop and livestock, at least ahead of the USDA report. They've been buying corn, but they're still short. So some buying power there if they decide to get long. Now, they were selling soybeans across the board into the USDA report and probably doing some short covering in the last couple days. When we look at profit and loss per acre for the three major crops, 2018 continues the trend in corn and wheat for the last 5 years, showing a loss. Soybeans eked out small profits the last 3 years, but they're also look like they're going to be money losing proposition for 2018. That's why it's really so important to sell any type of ounces here if you can. Looking finally, some input costs, growers need to be thinking about that. The nitrogen complex has been moving higher on the rally in wheat, basically, and optimism that growers around the world will need more, and that's lifted the rest of the fertilizer complex as well. So urea going to be more expensive than a year ago. Ammonia, a lot of producers probably going to be paying $450 to $500 for that. UAN also shows sharply higher prices on the swaps market in fall and winter. 28% will be expensive. DAP, of course, has a nitrogen component, so that's helping to lift prices. And again, farmers around the world just seem to be buying more. And even though we have increased capacity, a lot of that isn't hitting the market. Same thing with potash. The Canadian companies have learned how to dial back production. So potash getting more expensive as well. Diesel, this is the Gulf price. Normally we get opportunities in the winter, typically a little bit of a buying opportunity in the summer. We got that. The price hasn't broken much. It's going to depend on what happens to crude oil now, but farmer buying is going to be lifting cash markets for diesel. That's going to be getting more expensive. Propane, if you need it for heating or drying, that's already started a seasonal move, so it doesn't look like we're going to get a price break there. This is the Conway, Kansas hub price. If you buy out of the Gulf, the price there has been high since Hurricane Harvey. It seems to have really disrupted things down there, a lingering impact, making propane more expensive.